Welcome to the New York Business Leaders Podcast, presented by the Coyle Group. We interview the most interesting and influential business leaders in New York and hear their stories of success, challenges, and lessons learned while building their businesses and personal brands. New episodes drop weekly, so please be sure to subscribe to get updates on your favorite stream. Without further delay, here's your host of the New York Business Leaders Podcast, Gordon Coyle.
Welcome back to the New York Business Leaders Podcast. I'm your host, Gordon Coyle. In today's episode, I welcome Chris Okada from Okada Company to the show. Chris's firm is a fully integrated commercial real estate firm located in Manhattan. They own around 2.5 million square feet of commercial property in 45 buildings in midtown. Chris is a prolific deal maker and is engaged in ground-up development, property management, and commercial real estate brokering. In this conversation, we touch on a lot of what's going on in and around the New York commercial real estate market, as well as talk about Chris's new book, From Fear to Fortune: Generational Investment Opportunities in New York City Commercial Real Estate. Chris thinks that the next year or two will offer a once-in-a-generation opportunity for significant returns on real estate, despite all the bad news that the media wants us to believe about the marketplace. Be sure to check out Chris's book on his website, fromfeartofortune.net. You can catch Chris on social channels. I'll have all of that in the show notes as well as his website. And he welcomes an opportunity to speak to anyone interested in commercial real estate in New York. Great conversation, very interesting. So let's get on to it. Thanks. Welcome back to the show, everybody. My name is Gordon Coyle, host of the New York Business Leaders Podcast. Today, I've got Chris Okada on with me, who's a veteran of the commercial real estate business in New York City. Always an interesting topic of discussion. Everybody thinks the world is falling apart. Chris is going to talk to us about a new book his firm has published and about the trends of real estate in the city, commercial real estate. And rather than me jabbering on, Chris, why don't you take a couple minutes, introduce yourself, and tell us about what you're doing?
Awesome. Well, Gordon, thank you so much for having me. It's a pleasure. 360 videos, that a lot of work that goes into this. So I salute you,
Thank you.
Because behind the scenes, people don't understand the commitment and the dedication to get to 100, let alone close to 400 pieces of content that you created. So congratulations.
Thank you.
My name is Chris Okada. I am CEO of Okada Company. We're a commercial brokerage and investment company. We own and we represent on the leasing of 49 buildings in New York City, in midtown Manhattan. That's really my neck of the woods and my sandbox. And we have around 2.7 million square feet. Okada, our family office, this is our 54th year, and my father was very well known in the 70s and 80s for bringing over Toyota Motor Company, Honda, Sony, really the Fortune 500 Japanese manufacturing clients to the United States. And I myself focus more on the domestic and the local investing in Midtown Manhattan. And basically, that's kind of it in a nutshell. I am at Chris Okada on all social media platforms, and we did publish an ebook. It's been about a month at this point, and really, it's because we've been asked and we've been interviewed by many different types of people about the state of New York City and the state of commercial real estate in general. This is my 21st year. I started in New York City commercial real estate shortly after 9/11. And then really my claim to fame was, so far, let's see, I hope there's a lot more runway in this career. But during the financial crisis, I did about $1 billion of distressed mortgages collateralized mostly by hotel and office assets. The biggest deal I worked on was a Lehman Brothers asset that was $400 million and sold it for $217 million. And so the ebook that we released a month ago is called From Fear to Fortune: And you can check it out. Go on the website, www.fromfeartofortune.net. And it is a study. It is a research paper. It's really a white paper. But everything that I do really seeks the positive in situations. And in this case, with the post-pandemic world, with interest rates, with the FOMC and the Fed, and where everyone's nervous about next month. Is it a quarter point? Is it half a point? We're going through a lot of turbulence, and I'll call it turbulence, and it is scary. However, the report shows and tracks Manhattan Island from 1993 to year end 2022. And the study is really just about the historical trends of interest rates, the historical trends of capitalization rates and what people expected as far as ROI, and the property values of Manhattan, all assets below 96th Street. And essentially what we found is that we definitely did, from 2009 over the last 14 years, we did have a very, very low level of interest rates, and we all got used to that. We really did. But if you look at the last 50 years, and during the course of the study, 29 years, actually the average interest rate was 6.15. So, if today you can get a multifamily mortgage at around 5.75, which is substantially above 3% that we all got, or 3.5% or 4%, which is causing a lot of price readjusting and cash in refinances even on healthy assets, and other assets like maybe office is causing a lot of agita. It's a perfect storm. But actually, this is an opportunity to take a look at the data and tell yourself, okay, prices have been declining for a couple of years. On some asset classes were equal to prices in the bottom of the financial crisis. Are we as bad as the financial crisis? No, I don't think so. Interest rates did creep up to the 6%, maybe 6.5% levels. We've all been used to 3 to 4%, so that's difficult. But it's just really taking a wider view. And in the end, Manhattan, really speaking, New York City, really speaking, there has never been a decade that really prices stayed as low as they were from the previous economic recession. So, there is a recovery story, and I'm a big advocate, and I became in the New York City industry for the commercial real estate industry, really, to being a very pro New York City cheerleader, if you will. And there's a media company called Pincus and Company, and I was the MC and co-host of the NYC is Back rooftop spring event a couple of years ago. And then, so that's really it. This is a time to take a look at, take a step back, take a step away from CNBC, take a step away from Wall Street Journal, and just get quiet and really look at the data. And the data will indicate, regardless of where you are, that yes, expenses are going up. We've talked briefly about insurance, which is, no one's really talking about it. Only owners are complaining about it, but this is a nationwide thing that's happening, and there's a lot of readjusting to the post-pandemic world as far as insurance is concerned. And to take a step back and then to reassess your acquisition strategy. If you are an investor and you don't have a lot of risk and you don't have a lot of headaches, this probably could be an incredible opportunity for you to diversify and look at discounted or mispriced real estate. Even in the Sun Belt, multifamily in the Sun Belt was the thing to do, and probably still is in the psychology of a lot of institutional capital. But there's a lot of there's going to be mispriced capital in multifamily in the Sun Belt as well, I believe. Unless you have a 10-year fixed mortgage that you took out from a life insurance company or some kind of CMBS, I do think that actually rental rates are going to calm down as far as apartment rents. The way they were growing 20% a year is not sustainable. I think that there's going to be a little retraction from that. Capitalization rates, people were buying 4% returns. And if they have to refinance and they're seeing that, the best interest rate they could find is 5.75, it throws off the debt service coverage ratio. And Gordon, do me a favor, if I start getting too technical or too bookwormy.
Let's just stop here for a second and
Sure.
let's just dig into a couple things. So first off, the ebook Fear to Fortune,
Yeah.
I think that it really deserves a little conversation around disruption is really an opportunity that most people kind of see it as everybody running around with their hair on fire.
Sure.
But for the calmer real estate investor that's got some financing behind them, some money in the bank, it could be an incredible opportunity right now. So let's talk about that. What are you seeing there?
Oh, I'm seeing a lot. Two things. We tracked, I think there was a 400% increase in private equity raised for North American real estate, not only commercial, in 2021 and 2022 compared to 2008 and 2009. So a 4x in private equity. Yeah, there's a lot of money chasing. Now, they're saying that there's $2 trillion worth of commercial real estate that's going to come due in the next, 12 to 48 months, whatever. I'm sorry, 12 to 24 months. But yes.
When you say coming due, you mean in debt?
In debt. That's okay. That's what they're saying. And there's a lot of fear around that. And what Blackstone just announced, they raised $30 billion last week, them alone, and that is all going to be deployed. So there's a lot of capital on the sidelines waiting and looking and as you said, if you can get away from putting out fires, if you're an operator, or you create an arm, or you create a small team or a large team to go after some mispriced opportunities. In my opinion, this is once in a 25-year span. The last time we've seen this kind of price discount was 14 years ago. 14 years ago, I was a much different and younger person, if you will. And that's probably, the economic cycle is somewhere from 7 to 10 years. Last time it was longer because of the amount of quantitative easing. But really, I think that it's a 1 in a 24, 25-year time period today. Mm-hmm. That is not in single family. The discussion is when you look at your Zillow, you don't understand why are prices not coming down. Maybe they came down 100 grand on a $3 million property, but pricing, is for the single family. There's a housing shortage. So we're really talking about the middle level investment people. Mid-level meaning 3 million, 5 million, really 5 million in New York is sort of the watermark of where middle market begins. I think there's a tremendous opportunity in middle market, 5 million to $250 million. I think that is where people are nervous. But I believe that that's where most of the opportunities are. Properties that are $1 million and investment grade properties, they'll get scooped up, $1 million, $2 million, $3 million. that's, I don't see that. I don't see any problems in single family yet. There has to be a major bank issue that pops up. But yeah, this is once in a generational opportunity to acquire distressed commercial real estate. And I think that's in most gateway cities, not Miami. I think that's in, I think Texas did a lot of building over the last decade, and you can continue. It's just like any business cycle. You can be in hyper growth mode, but there's always some pullback, whether it's infrastructure reasons, whether it's population reasons, whether it's just it was overbuilt. There could be rental reduction, but I do believe that this is a once in a generation, if not a once in a lifetime opportunity to scoop up distressed property.
And when you're talking about that $5 to $250 million band, are you talking about multifamily, office, retail, warehouse? What segment are you talking about?
Great question. So our study is really New York City, but because you have a national audience, let's talk about nationally. I think that for cash flow purposes, the safest would probably fall in the industrial, fully leased industrial. I think that that's a wonderful place to be. You're not going to find a lot of yield. You're not going to, that is probably equivalent to a 4 or 5% note, treasury, if that. So I think that the 5% coupon and the lower level of return is probably an industrial, and for a lot of multifamily, I think is also very, very safe. I don't see, in prime areas, you seeing a 30% discount in multifamily yet. Not sure, TBD. Because of the Zillow effect and the single family effect, no one wants to take out a 6.5% mortgage. If they have a budget of, let's say, $3,000 a month, they could have bought something in 21. But there was so much competition that each house had 20 other offers. It was just almost nearly impossible to buy. So people are renting. And the millennials are the generation that is really, in the driver's seat right now, as far as first-time home buyers and renters. So millennials, if you track demographic data, they are, getting married a little later. They are moving out of their parents' home a little bit later. It's all fine. This is a generational demographic shift that's happening. And when they do, they're buying their first home, where, I would say, 20 years ago at 30 years old, you're probably you're getting married, you have kids, and your first home all within probably at 30 years old. Now I'm feeling that it's getting later and later, just because of the initial down payment of a home, the carry of a mortgage, and bank strictness.
Yeah, underwriting has certainly impacted a lot of ability to purchase a home in what I'm kind of seeing on the periphery.
Yeah. So next is the mild risk level and mild ROI. And that would probably be in more, I would say, hotels. Hotels are a very interesting asset class because it's fun, but it's also a business. You're not buying an apartment building and having a property manager. In this, banks and lenders look at it as a business. And it's housed by real estate. It's not a real estate that houses tenant. The hotel has a brand. It has 3 times as much staff as an apartment building would have for 3-star, let's say 3 to 4-star level hotels, and 5-star even more. And the hospitality, the nationwide hotels, they're doing better than ever. People are starting to travel again. People they want to get out, they want to get away from home. They've been stuck at home for a couple of years. And people are now for the first time going to their first event since COVID and their first vacation. They're still doing their first vacation since 2020.
Mm-hmm.
So we're seeing that there is a loss in business travel because of Zoom and technologies of work from home and remote work. But I'd like to say that if lenders were more bullish on the hotel business and use the trailing 12, I think that it's a wonderful story. And and other sort of assets in the mild would probably be retail. And I use that retail as a big category. Strip malls, are all very different. I'm talking about, in my case, urban, midtown Manhattan, on the avenue or side street retail. It's having an incredible time because it had gone through for 8 years, really 5 years post-COVID, the retail apocalypse, the Amazon effect. And so prices really dropped and plummeted, rents really plummeted. But now, because of the restaurant and hospitality, people want to go out.
Mm-hmm.
They ordered Uber Eats and Grubhub and Seamless. They're over it. They'll still do it,
Right.
but there's definitely a lot more socializing.
Yeah, I think the experience of going out for dinner is kind of a refreshed activity for people.
Sure.
Now, so just going back to the hospitality for a minute, those investors are really operational people. They need to be in that hospitality segment. Is that kind of what you're saying? So it's a different breed of investor that may be willing to invest in multifamily or industrial or something of that nature. They need to be hotel people.
Yeah. Either they have to have a very diverse and a large staff to support that, and or they have some hospitality experience. But yeah, it is a day-to-day. The leases of the property are 24 hours. For the nightly visits, and it's not a 30-day or a 12-month lease the way. So because of the short-term aspect of the lease period, it is definitely very operationally intensive. And yeah, for your audience, I think that if anyone does have any ambitions to get into hospitality, that's really where you have to pay attention on a day-to-day and it's a highly operative, it's a business, correct? It's really like running a restaurant. The type of restaurant, and there's levels of this. You can have a Days Inn, and that's a little potentially less hands-on, and the most expensive would be a 5-star. And that is truly quality control and brand control. And so you may not want to be into that. What you can do is, if you do have ambitions of running a hotel or owning a hotel, you would partner with a brand like Marriott or Hilton, and it could be a completely management agreement, and they run it and they do everything. And they have either a management fee or they have a percentage of sales. And in that way, it's a little less hands-on. But you're gonna have to have an understanding of ADRs, operating, and there's a whole science behind the hotel business that I don't own a single hotel, but my partner has 15. And he's diversifying a little bit away from that. Just because it's the same as all investment theses. You're going to want to have diversification of assets, asset classes, and location. So they're doing that. But yeah, absolutely. I think the profit margins are higher, but when it's good, it's really good with hotels. When it's bad, it's really
It's really bad.
yeah. And
And if
so
operators were able to weather the storm of the pandemic, they're probably sitting in a pretty good position. They may have been able to renegotiate debt on those buildings during the time of the pandemic. So they've got a lower operating cost. They've probably made concessions with unions or whatever. I'm kind of just thinking off the top of my head, is that in fact true?
New York City had around 40,000 rooms closed permanently.
Mm,
The cost of labor and the labor shortage with that, it's as strange as it sounds, there's a labor shortage. It's even a restaurant is having problems keeping their managers and keeping their wait staff and
yeah,
servers. So it's an interesting time. It's almost a perfect COVID for hotels was almost a perfect storm of labor issues, of demand and revenue issues, and then of mortgage and interest rate issues.
mhm,
But I would like to say that as far as New York City is concerned, a lot of the operators that survived are doing very, very well now.
yeah, yeah.
Less competition, 40,000 rooms, and the travel is back, and hopefully they took out 5-7 year mortgages or had an extension or renegotiated before 2022,
Mhm.
before June of 2022. Really, that's when the game began. June of 2022 with the interest rate hikes.
Yeah. Something I want to go back to is a phrase that you've used several times. It's mispriced real estate. Can you tell us what you mean by that?
Yeah, I'd like to say that Warren Buffett, he's one of my greatest virtual mentors, if you will, along with a lot of people. But he said, he was asked, how come you don't play in real estate? And he goes, well, because of our C Corp structure, we have less of a tax advantage than an LLC, et cetera, et cetera. But he got into it. And what he said was that when liquidity is pulled from the market, real estate is probably one of the most efficient markets as far as pricing is concerned. The only time there is mispriced values is when banks stop lending, essentially, or when there's some kind of crisis. So if you look at any asset class, being mispriced is that there's a special situation like a lawsuit or feuding a family or foreclosure situations, and it's quiet. Every town across America has assets that are mispriced, and a vast majority of people start off, maybe they want a 2-family home as an investment, or a 3-family. Even as small as that, there are stories. It takes a lot of work. Just like everything, every business is the same. How do you get leads on properties? How do you find them? How do you negotiate with them? How do you structure the deal? So there are definitely in your hometown, wherever you are. I mean, I'm not, I would say even in the hottest market in Miami, if Miami or Houston or wherever you consider in New York City, there are opportunities for sure that are mispriced. And in a hot market, um, uh, essentially properties will sell at a negative leverage. If mortgage rates are 6% and you're buying a 4%, deal, that's called you're at 200 basis points negative leverage. And so you have to run your model with that. And that's not really sustainable long term, in my opinion. But mispriced in a hot market is, can you find a 6% capitalization rate in Miami? Is that possible? Where is it? And it may have to be a little further out from Brickell, may have to be further north, may have to be, but there are opportunities that are sort of, it's that small handful of opportunities. If you have a hundred pennies and you pick out the shiny penny, the 5 shiny pennies, and you go for those are mispriced opportunities, in my opinion.
Okay.
And it may not be a good time to invest in the South if all the Northerners are coming down with their $500 billion of spend equity. Your greatest asset is probably your local knowledge and your local network, and then you can try to sell to those people.
Well, it's funny that you mentioned Brickell, because it seems like every time we have a client moving from Park Avenue, they're on Brickell Avenue in Miami.
Yeah.
And, maybe they're only leasing an office space, but, not to interject too much insurance conversation here, but one of the hammers that investors are going to have to be aware of is if the budget calls for whatever premium on your insurance expense to be, you can probably expect that to be 2x in the next 2 to 3 years, and maybe 4x, including wind and flood, if you're owning real estate in the Miami market, because it's only a matter of time that becomes exorbitantly expensive to insure. So that's a multiple factor that has to be considered, I think.
Yeah, interesting you mentioned about that. I heard there was an article yesterday or this week about a blacklist from insurance companies and banks, and basically put, because of the that collapse in Miami, their whole lists of properties that have been populated by large insurance companies and large lenders that feel that because of the natural elements of a property and a location, that they are not interested in lending. So that would even further exacerbate any premiums in insurance. If there's not a lot of players that are willing to take on that risk, because they're nationwide and they don't have to do this business in Miami,
right?
And then with Fort Lauderdale, I think, wasn't Fort Lauderdale underwater this past week, the airport? And
yeah, that's right. These 1-in-100-year storms are occurring every 4 years, so it's going to be a problem.
So that's a very, very valid point, is to look at the didn't see it coming aspect of property investing of any business.
Right.
And I think going up and down your expense items, and then really taking a dig into that and seeing what happens. I think people get into, especially when you're acquiring, you get into the we got to get it done. Let's move forward. We have the investor equity, that they don't really take enough time to plug in a 2x on their insurance. What would that look like?
Right. Or in New York City, I'm not very well versed in this, but the move to green buildings,
sure,
and energy savings, that's going to be a huge expense for conversion in a lot of buildings.
Huge expense of getting rid of fossil fuels.
Yeah.
I don't know what all the co-ops built in the 70s and 50s and 20s, let's say it's a 400-unit co-op building, all those owners. And I think that they may have to extend local, and it's called in Local Law 97, where technically in 2 years, they start penalizing small amounts of violations for buildings that aren't doing that aren't moving towards being green, that are over 25,000 square feet. So I think that's a huge thing to go mostly electric. And that means removing boilers and infrastructure from from risers of electric to increasing the energy. We may see that. I don't know. Well, let's see what the Manhattan electric grid can support. If everyone goes to electric, I mean, you're gonna have some flickering lights. I don't know. I don't know how.
It's certainly going to be a challenge, not only for the operators. Just think about a pre-war building on the east side that's got 300 units in it.
Yeah.
Walls that are 2.5 foot thick of masonry. All the gas pipes are in there. Now you're going to convert every appliance over to electric. Just the construction cost is going to be exorbitant.
Yeah.
Then you're going to have to upgrade the infrastructure within the building,
Yeah.
the amperage coming into the building, and like you said, where's all that juice going to come from? And I'm no scientist on this, but it's a huge undertaking, and we just don't see, from my perspective, that Washington can get anything done. Never mind, from federal to state to local governments being able to accomplish anything of this magnitude. It just seems to be, and I'm all for, going green and electrifying. I think it's the right thing to do for our future, but I just don't see it happening within the timeframes that most governments are mandating.
Yeah, I think it was swept into the whole movement when we weren't putting out fires, right? When we're not putting out fires, we're really paying attention to the front lawn and being like, the front lawn's got to be perfect, guys. Like looking at at all the landscaping and stuff when you may have a small fire in the basement, but yes, I think it's going to be a challenge. I think that there will be extension of deadlines. New York City houses 8.5 million approximately people, and they're saying that it's going to grow to 9 million people by the end of the decade. So infrastructurally, I think it's a challenge. I think that affordable housing is a big movement that's going. And there's hundreds of thousands of apartments throughout New York City that are run by the city, whether it's housing projects, whether it's affordable housing, whatever it is. What are they going to do? They can't even keep bricks from falling.
Yeah,
the building. So I think that it was a good intention piece of legislature that is a lot more challenging to that operationally and to execute than but that's a whole nother sort of conversation. Is the issues with local politics. And for all your business people that are watching this, I think local government and their governmental restrictions is a huge part of how to get financially free and how to navigate. And it is true. Look at San Francisco. I'm very, very moderate. I'm right down the aisle as far as political spectrum is concerned. I tend to be more financially conservative when it comes to money, when it comes to business. But it is, look at San Francisco. Now, some of it is media hype. Some of it's social media sort of bashing. And the same goes for New York City. A lot of it's not true. Is New York safe? Yes. Is it, does the media capture a lot of crime? Yes. That's what they like. They like crime and celebrity. That's what news.
That's right.
They need clicks.
Right.
Not going to click because Gordon Coyle is a good Samaritan. They're not. That's that story of you helping, your neighbor bring home the groceries. That doesn't do it. What does do it is celebrity, fanfare, crime, gossip. Unfortunately, that's what moves, the needle.
Yeah. Well, and I think that goes back to the beginning of this conversation. And you said that chaos, which is really what we're talking about here. Chaos is really how do I put it? The wolf in sheep's clothing that is disguised as opportunity, or vice versa. But getting back to what you started with is that we're in a state of somewhat chaos. There's a lot of disruption, interest rates, occupancy. The media is hyping that no one's going back to work. Meanwhile, there's law firms that are fighting over space to house all the people that are coming back to work. So, kind of like wrapping this up, let's talk about what the opportunities are for that middle market investor. Where do you see that really getting deployed?
I definitely see land development. Land pricing is slashed in half compared to its peak in midtown. I sold a piece of land on 23rd, or future development of property on 23rd Street. At a basis of over $700 per square foot. Today, land is trading somewhere in the 400 range.
Wow.
Maybe. So we're seeing real price decline, and that's for all asset classes. If you want to build, if you have any desire to build in the future and you want to construct something beautiful that's meaningful, even apartments, condos, if you want to build spec office, I'd like to say land prices have plummeted tremendously since 2016, 2018, and that sort of thing. There's a lot in that. However, the cost to acquire that land is now 11%. So where it used to be maybe 6-7%, maybe 8%, really whatever the Fed did, you just add 4 to 5% on your interest rate. And that's why there's that sort of dynamic of lowered pricing. Second to that is that eventually, just like the retail apocalypse, eventually spaces will be absorbed. Now, are we early in this process? I think we're probably a little early in the process, but take a look and be cautiously curious about office values and office pricing in very well popular located locations. Yes. Is vacancies up historically? Absolutely. Is this evolutionarily a change in how we use office space? 100%. But plug those numbers in. Let's say you will forever have a 15% vacancy, and that's like, where it used to just have a 5% vacancy in your underwriting. Put in 15, put in 20. At what price point does it make sense to roll the dice and say, I need I need a 6.5, I need a 7% RO capitalization rate, 6.5%, and that's sufficient for me. I feel that if it's prime real estate and we have a 15% vacancy, we plugged in a 30% drop in rent, and we really mark to market the office property, and this is not for everyone. Blackstone raised $30 billion. In bold, they said every asset class but office, right? So even Blackstone, with their latest fund, is really shying away from office as an asset class in general. But because everyone is, looking away, yes, it's dangerous, but price that in. What is the risk reward ROI for you as an investor? And then map that out and underwrite that. So I think land is a very risky and very high reward scenario, 2x, 3x. I think land development also, same thing, but you have to price in longer construction periods because construction just takes longer in general. And you're going to have to price in sort of the new era of interest rates, which is 10%, 11. People can say, I could get you 9, I could get you 8. Wonderful. But they're non-traditional lenders, and they're probably private equity firms, and private equity firms need a low teens IRR. So do the math. They're giving you an 8% construction loan that I'm aware of. And so those two asset classes, I feel, have a potential. Pay attention to that. If you have any ambitions, and you just got to take a look inside, and you have to take a step back and think, what kind of investor am I? And be honest with yourself, because sometimes you do have ambitions, you do have passion to want to develop ground up. But then when you really look at it, it's a tremendous amount of time. And so spread out whatever profits and income you feel you'll make, spread that over 5 years, and then take a look at that and say, can I settle for that? And if it doesn't work, then this is not for me. Why take on the construction risk? Right. So everyone's acquisition criteria should be modified. If you're an investor and you've been investing for 20 years, 10 years, even 2 years, your acquisition criteria should be modified and adjusted for the modern world. And people in general have done that. A lot of people have. But just like a pruning of a tree or a plant, it's important to adjust and then to adjust your risk reward sentiment. If you're younger, you're going to say, you know what, this is my chance. I'm not going to do this in my 60s. So this is my chance to really try to go for the 2x, 3x if possible as a general partner. Let me try.
This is where, and kind of wrapping up a bit, this is where bringing in somebody with your breadth of experience can help an investor or an investor group understand the dynamics and make the right decisions. Am I right? I'm not trying to promote you here too much.
No, thank you for that.
But that's really what it comes down to. You can experiment without really the expertise, or you can hire an expert to do all this background work for you, correct?
Correct. So yes, our firm, we are on a day-to-day looking at and acquiring opportunities, and we have our own investment thesis. Our investment minimum, we lowered it. It used to be $250,000 to partner with us as an individual investor. But we're seeing that, really led by the private equity real estate world, that they've lowered their minimums down to $50,000 and $25,000. So we also, that's a very interesting trend, because they're expanding their investment base. So we're also doing the same thing, where our investment minimums now are $25,000. So you have to be accredited. It's on a deal by deal basis. And it's really a long-term look. But yes, I feel that if you partner with a company like Okada Company, or you partner with another general partner that does this on a daily basis, your statistically, your chances of success should increase pretty dramatically versus going off and putting all your money into an asset that you're not too familiar with. Yeah. So with that said, I do encourage people to really think about alternative assets, to think about real estate, to think about this as a wonderful opportunity, to step away from the fanfare and the newspaper and the media, and to really look at the data and make your own decision, and then execute on that, because we are having this topsy-turvy economic cycle. It's an opportunity, and that's why the study is called From Fear to Fortune, and you could look that up at fromfeartofortune.net.
And I'll be sure to include that in the show notes, so anybody who's interested can look at that. So kind of wrapping up, if somebody wanted to get in touch with you and talk about ideas, opportunities, is that all right?
Yeah, I would love that.
How's the best way to do that?
Instagram at Chris Okada, or LinkedIn, Christopher Okada, and same as Twitter. My Twitter has been wonderful. I've been on Twitter for a while, but sort of recently re-engaged. I think that you could reach out on Twitter. And our website is okadaco.com. and okadaco.com. But either that or just fill out the form on fromfeartofortune.net, and we can have a meaningful conversation.
That's
And
great.
I'm definitely not a high pushy salesperson. That's never it. You never want to push, but for anyone that does want to take a deeper dive, maybe even educationally or philosophically about investing and making money, I think that we really are trying to make make financial impact, and that's how that's why we're on the podcast. We want to spread knowledge and give optimism and motivation to look within, and then look at the data, and not only react to the media and social media. Make a decision that way.
And I think that's what happens to so many people, regardless of the industry or their day, they just get so wrapped up into this, like we said earlier, chaos, that they miss the potential opportunities that exist. And I think this has been true across different investment asset classes. When there's chaos, there is opportunity. And it's being able to separate yourself emotionally from that chaos. And I think the title of your book, Fear to Fortune, is a good one. I'd encourage anybody that is interested to download that, take a look at it, and contact Chris and have a conversation. If you've got money that you want to put into this asset class, I think it's a great idea to have those conversations and see where it leads.
Great. So, I mean, that's pretty much it, right? Are we out of time?
I think we're wrapping up. I think we covered a lot of good material here. Chris, thanks so much for being on the show with us. And before we go, if anybody out there who's watching or listening to this has a great story like Chris's, give me a call, drop me an email. I'd love to have you on the show, talk about these issues, help the audience kind of be a little bit more enlightened about whatever you do. So, Chris, thanks again for being on the show.
All right, Gordon, thanks for having me. And for all the listeners, would love to hear from you, and please reach out.
Great. And until next time, stay well. Thanks.
That's it for this week's episode of the New York Business Leaders Podcast. Be sure to subscribe so you don't miss next week's episode. In the meantime, find more interviews and resources at nybusinessleaders.com.